All right, let's jump right into it. Today we're digging into Digi International's latest earnings, their pivotal Q4 2025 results. We're going to look at the numbers, what's driving them, and most importantly, what it means for the stock.
Okay, first things first, the market's reaction. The stock shot up over 7% the day after the call. So what did they hear that they liked so much? Let's break it down.
So, let's start with the big picture. The Q4 beat. And you know what? They really did exceed expectations. This was a super strong quarter, a solid beat on both revenue and earnings. All right, take a look at these headline numbers. Revenue hit $114.3 million. Now that's not just up almost 9% from last year, it also beat what the analysts were predicting by a good 3 to 4%. But here's the really impressive part. Adjusted earnings per share came in at 56 cents. That's almost 10% higher than what Wall Street was expecting. A really nice beat on the bottom line.
And this chart just lays it out perfectly, right? That 56 cents in actual adjusted EPS is sitting well above the 51 cents consensus. That's the kind of outperformance investors love to see.
Okay, so a beat is great, but what's really exciting here is the why behind it. This isn't just a one-off good quarter. It's all about a massive strategic shift they're making. They are pivoting hard into recurring revenue. And for any investor, that's the magic word, isn't it? It means predictable cash flow, customers that stick around, and ultimately a higher valuation for the company. And this is where you really see that pivot paying off. Look at this. Their annual recurring revenue, or ARR, just hit a record $152 million. I mean, that's a 31% jump in just 1 year. And now, that sticky, predictable revenue makes up a whopping 35% of their total sales. This isn't just a plan anymore. You're seeing the transformation happen in real time.
So what you've got now is really a tale of two different businesses inside one company. On one hand, you have their new high-growth IoT Solutions segment. This is all the software and services stuff, and it's on fire, growing at 23%. On the other hand, you have their older legacy products business, still growing, but at a much more, let's say, mature pace of 4%. And the CEO, Ron Konezny, he was all over this on the earnings call. He made it crystal clear. This isn't some little side hustle. This transition to recurring revenue is the strategy. It's the whole ballgame for them now.
All right, so that was the past quarter. But what about the future? Well, management didn't just give us next quarter's guidance. They laid out a pretty bold path forward.
They've got this big, long-term vision they're calling 200-200. What does that mean? It means they're aiming for $200 million in that all-important annual recurring revenue and $200 million in adjusted EBITDA by the end of fiscal 2028. That is a huge, ambitious goal, and it tells you everything you need to know about how confident they are in this new model. Okay, so what about the nearer term? For next year, fiscal 2026, they're guiding for double-digit growth everywhere that matters: ARR, revenue, and adjusted EBITDA. But here's the key takeaway. They expect profits, that adjusted EBITDA, to grow even faster than revenue. That's the textbook definition of expanding margins and operating leverage.
Now, it can't all be sunshine and roses, right? A smart investment means looking at the potential downsides, too. So let's talk about the risks and catalysts.
So, the bull case here is pretty straightforward. If they keep growing that recurring revenue and successfully integrate their recent acquisition, Jolt, then margins should expand and the stock should do really well. The bear case? Well, it all comes down to execution. Can they actually pull off that integration smoothly? And will they face any margin pressure in that fast-growing solutions segment? That's the real question.
So what did Wall Street think? Well, the analysts definitely seemed to side with the bulls. We saw Craig Hollum upgrade the stock to a buy with a $45 target. And B. Riley, they stuck with their buy and actually bumped their price target up to $48. And what was their reasoning? You guessed it, that awesome recurring revenue story.
All right, we've heard from the company. We've heard from Wall Street. Now it's time for our take. After crunching all the numbers, what's our call on DGII?
So what is our call? Let's get right to it.
Here's our forward prediction. We think the momentum continues. We're expecting another really solid quarter, and honestly, we wouldn't be surprised to see them beat the high end of their own guidance. As the market keeps catching on to this recurring revenue story, we think the stock price is going to keep climbing.
So, our official rating on Digi International is outperform. The bottom line is this: their big strategic pivot isn't just a slide deck fantasy, it is working. They're churning out cash, paying down debt, and setting themselves up beautifully to grow their earnings for years to come. So really, the question isn't if this strategy works anymore. The question is, how fast can they get there? How quickly can they hit that ambitious 200/200 goal?
It's gonna be fascinating to watch. And of course, please remember, this is not financial advice.